Greetings. Chapter 5, In a Year of Profit, 52 Proven Business Strategies to Add to Your Bottom Line by Mark Daniels and a few other great little helpers there in the book. And so today's lesson, twofold. Firstly, about the difference between margin and markup. I can recall many years ago in the first Coach, a business fact in those days, first question of me, what's the difference between margin and markup? I didn't know, I had to look it up. So put simply, in my book I've given you a diagram. Quite important to know this because often we can overestimate what profit we're making and underestimate how much effectively to put onto that product. So a very simple example in the book is we buy or make a product that costs us $10 and we mark up of 50%. So 50% or 1.50, if you want to do the flash maths way, or a 50% markup is on $10 is a total of $15. So we've marked it up 50%. But the margin, what we get to keep, is actually only a third of that. So our cost is 10, what we've marked it up by 50% is 5, but $5 is 1/3 of $15. So we get to keep all the margin. In this case, it would be a gross margin. That's probably for another episode, but the gross margin, the amount that we can keep from that particular sale is $5 or 30% of the total sale of 15. So you might think, not overly complicated that, I know that, but that is of course gross margin. So where gross and net margins come in, gross margin doesn't take into account that $5 of profit is gross profit because there are other costs to come off there. And what costs can you think of? Tons of them. Advertising, office team, valuable office team needed to do the work of processing the business, and you could call them an overhead, but they're a very valuable overhead. Not a very good name, you're an overhead, but it's considered in an accounting sense an overhead. So some little diagrams are going to flash past here. So we're given an example, which you're going to see next, of an estimation of what overheads might be, so that we can add those up and allow something so that we can price that particular product correctly. Okay, so we've marked it up by 50%, meaning we keep $5. But what if the other costs in the business reduce that down significantly? They probably will. So the example in the book I've used is a builder, and he established that his overheads were about 100,000. So on his turnover, that meant that about 11% of his total turnover was overhead. So quite simply, we said, well, if he could add 11% on, or consider 11%, either take that off of that gross profit. He doesn't quite get all that, and obviously there's things like tax, but we'll come back to that. So he needs to allow in his quoting, he or she, an amount there to cover the overheads. And what overheads can you think of? If you go into your accounts given to you by your accountant, and you may not have been over familiar with those, but hey, hang in there with me. Go and have a look at those and you'll see the items that are there. There are a whole lot of things like ACC, even things like GST, but those on GSTs and in and out in New Zealand transactions, so you probably don't have to worry about that too much. But there are a lot of other costs that you'll incur: printing, stationery, computers, phone, a lot. So that all adds up to vehicles, adds up to an amount. So when we're quoting a job, and I've used the example of a builder, another little diagram will flash across here, the cost to the builder. So let's say he's building a small shed, small aluminium shed, or wooden shed, doesn't matter. The cost of the slab for the shed's $5,000, we've allowed here. The kit set is 20. Labour is allowed as 10, giving a subtotal of 35. And we've then added in an overhead charge at about 10% on that of 3,500, giving us a total of 38,500. Nothing too amazing or spectacular about that, but it is very important to understand that he isn't going to make the net off those things without adding in that overhead, and that's very important. And so the chapter 5 is about allowing that correct overhead, calculating it in and putting it down. Now you might say, that's good, I've done that, do that. What if you get a job that's $1 million shed? Would you put an overhead of 10%? Probably not. You wouldn't need all that recovery. So what we're saying is a sliding scale, and you'll see a little diagram come past next showing that maybe the quotes of 0 to 150,000 or something like that use a 10% margin. And obviously slide down. If you get a really big job, it would cover something for your overheads, but it doesn't need to be the whole 10%. And it's a matter of just making sure that you allow for that going forward. Now, I mentioned before gross and net margins. Obviously, well, not obviously, but I would call that a gross profit. And net profit ultimately is once the accountant's processed this thing. There's two exceptions there, and I've said in the book here. The second exception, obviously, the first one being using a sliding scale of 10% for smaller jobs and maybe 2% for larger jobs. The second exception, of course, is the net profit calculation. Now, your accountant will process that figure and take off things like depreciation, and there are other allowances that are, if you like, they call them non-tax. So to sum it up, first thing, know the difference between your margin and your markup. They are not the same, they're quite different. And this actually can cause trouble in discounting, because you think, no, we've got a great markup, a main margin on that 50, actually, no, we've got a margin of 33, not 50. So if you go and discount too heavily, you might be selling below cost. That's the first thing, is know that margin and markup are different. Secondly, know what your overhead costs are. Go and work them out, and then try and apply as much as you can to each job without losing it. Now, you can't put a line in your quote that says overhead. People won't buy that or say, I'm not paying this overhead. So you really have to include that in the overall cost of doing that job. So that's that particular chapter, short and sweet, but very important. And so if you'd like more information on that, email me at markdaniels@actioncoach.com. Secondly, if you'd like some big offers today, 3 offers if you'd like an hour discussing this material for no cost, we can. If you'd like a copy of this book or The Quiet Sales Genius, my other book, email us. If you'd like a free little team training, we could do one online, or if you're close enough, I can drive to you. A couple of hours on that. I could do that as an introductory offer at no cost, because these days team is everything. Getting and keeping good team, not an overhead topic. Well, they are in a sense overhead, but are they good overhead? So think about some of those offers there. Give me an email if you want some help. Always pleased to add to our mission, which is to touch 2,000 businesses to try and meet the Action Coach vision, which is world abundance through business re-education. So if we can talk to a couple of thousand businesses a year in some way, shape or form, that helps to meet that mission of Action Coach World Abundance through business re-education.